Well, Dan Lacalle joins us, Chief Economist at Tressis Gestion. Karen and Steve will jump in as well, of course. Dan, let's come to you here. What was new that you heard from the Federal Reserve that you think has an impact on the way asset classes are going to trade?
Yes, I think that one of the key factors actually was that they decided not to do anything in terms of yield control and yield curve control. And I think that that is something that many investors are going to pay a lot of attention to, considering that it might be because the Fed is more concerned about deflationary pressures than what investment banks and analysts have been talking about, particularly in this cyclical rally. So I think that that was one of the things. Obviously, the other was that Mr. Powell was evidently concerned about the very rapid rise of markets and the expectations of a very quick recovery, considering the data that they're working with.
The messaging around asset price bubbles I thought was very interesting as well, Dan, here. The questions were asked of Jay Powell, but he patted them away, saying that growth and employment and inflation are the Fed's job, not to worry about asset prices. Is this an abrogation of the Fed's responsibility, given that many market analysts believe that all this liquidity is not finding its way to the real economy? It is instead finding its way into stocks through Robinhood accounts and other broking accounts.
Absolutely. I think that it is quite irresponsible from the Fed to say that they're not concerned about asset prices. They should be. They should be, because they know that if asset prices go well beyond the realistic valuations, if they see that there's bubbles building in equities and bonds, they know that that can have very significant effects on the real economy when those bubbles burst. So I think that central banks should pay a lot more attention to asset prices and actually listen to investors that are telling them that current increases in valuations and multiple expansion are driven precisely because of huge liquidity increases in a centralized lockdown of the economy. That all that liquidity is not needed at the moment.